Hello again. This is John Daniels here with session 1.3 of Jesus and the Magic Money Tree. Borrowing from the future. Where does money come from? What did we learn last time in session 2? Well, first of all, that there are three ways of understanding what money is. First of all, a commodity representing the value of other useful things. Secondly, a relationship of credit and debt between people. And thirdly, whatever the government will accept as tax. And taken together, those three aspects bring to light important things about money. First of all, it's there in order to enable us to access other useful things which are not money. Secondly, it's all about our relationships with other people, with peers, into whom we enter into relationships of credit and debt. We owe people things, people owe things to us. Money is a claim on the wealth of others. And also that we're always already, as people, embedded in a political context. We're not just a horizontal society exchanging goods and services with each other. The rules by which those goods and services are exchanged have to be agreed and implemented by a body which exercises political power. So whatever the government will accept as tax also, in some very important respect, counts as money, because government decides what the rules are. So what does money do? Well, it does three different things, we noticed. First of all, it acts as a means or a medium of exchange, provides a store of value, and it provides a unit of account. And we noticed that a single money system can struggle to do all these three things well at once. So, without further ado, let's move on to the questions for this session. Question number 1. When your high street bank makes you a loan, where does the money come from? Is it A, money deposited in the bank by other people and companies? Is it B, money lent to the bank by the Bank of England? Is it C, dividends from Queen Anne's bounty, a sum of money invested by Queen Anne in the East India Company in 1710? Is it D, created out of thin air by the bank? Or E, does it come from Jeremy Corbyn's fabled magic money tree? Pause the video for a moment to have a think about that. The answer is D. It's created out of thin air by the bank. How on earth does that happen? Well, the story of how this happens goes all the way back to the early 17th century. At that time, goldsmiths had become very significant figures because people used to deposit their gold, their silver, and other valuables with them for safekeeping in their vaults. The goldsmiths would issue deposit receipts in return. Now, these deposit receipts were a form of IOU. Three hugely important developments followed from this. First, over the course of time, people began to use these deposit receipts, or IOUs, as a form of cash or means of exchange in everyday purchases, rather like we used to use endorsed checks back in the day. Second, goldsmiths came to realize that they could lend out some of those gold and silver coins which they held on deposit and charge interest to the borrowers in doing so. And this could be very profitable, obviously, especially as loans were made on the basis of compound interest. But we'll come back to compound interest a little later. And finally, the goldsmiths also realized that since their deposit receipts were now being widely used as cash, as we noticed a moment ago, borrowers would be prepared to accept loans issued in the form of these receipts, rather than insist on gold or silver coinage. As a result, goldsmiths were able to loan out receipts for more coinage than they actually held. After all, who'd know the difference? Provided people trusted the goldsmith, that is, they believed that he held enough hard currency in the form of gold and silver to cash in a given receipt, everyone was happy. These are the origins of today's fractional reserve banking, the practice of lending out more money effectively in the form of IOUs than you actually hold. This extra money is created out of thin air. Banks, the present-day equivalents of goldsmiths, literally have a license to print money. So, for example, at the time of the 2008 financial crash, commercial banks held just £1.25 in central bank reserves for every £100 loaned out to customers. Now, if you find that a little bit surprising, if not shocking, then you wouldn't be the first to do so. Lord Stamp, former Bank of England director, said this: "The modern banking system manufactures money out of nothing. The process is perhaps the most astounding piece of sleight of hand that was ever invented." J.K. Galbraith had this to say: "The process by which banks create money is so simple, the mind is repelled." What about these words attributed to Henry Ford? "It's well enough that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." On to question 2. In 1694, a group of wealthy merchants lent King William III of England, William of Orange, £1.2 million to spend on war against the French, repayable at 8% per annum. What were the king's creditors allowed to do in return? Was it A, to drive their sheep and cattle across Tower Bridge? Was it B, to use Buckingham Palace as a venue for garden parties? Was it C, to nominate a Prime Minister? Or was it D, to create their own private bank with unique public privileges? Pause the video to have a think. The answer is D, to create their own private bank with unique public privileges. As anthropologist David Graeber puts it, they received a royal monopoly on the issuance of banknotes. What this meant in practice was they had the right to advance IOUs for a portion of the money the king now owed them to any inhabitant of the kingdom willing to borrow from them or willing to deposit their own money in the bank. In effect, to circulate or monetize the newly created royal debt. And this is why Bank of England notes still bear the legend, "I promise to pay the bearer on demand the sum of." It is a mere IOU in essence, and so reflects a relationship between people. The chief cashier representing the Bank of England, and so the state's creditors, those from whom the state has borrowed, and finally the bearer of the IOU, that's you or me. And this reflects the credit theory of money, whereby money simply means a bond, a social bond of credit and debt. Money doesn't have any value in and of itself. It's just a claim on the wealth of others. That's why it can take the form of a piece of paper, or increasingly these days, just a number stored in a computer somewhere. And David Graeber goes on, "To this day, the founding loan of the Bank of England has never been paid back. It cannot be. If it were, the entire monetary system of Great Britain would cease to exist." Here's a graph which you might want to pause the video to ponder for a moment. It shows gross domestic product, GDP, per capita per person in England between 1270 and around about 1850. And that red line shows whenabouts the Bank of England was founded. Take a moment to look at that graph and see what you notice about it. What strikes me looking at it is that all the way up until around about 1650 or so, with a few ups and downs, the line is pretty flat. True, there's a step change around about 1350, which I suspect may have something to do with the Black Death. But what's absent up until around the mid-17th century is what's known as economic growth. In other words, GDP per capita remains roughly flat. But then around about the middle of the 17th century, it starts to climb. And in fact, between 1660 and 1704, it shows an average growth rate of 1.5% per annum. May not sound a great deal, but against the backcloth of no growth at all overall, suddenly England found itself in a situation whereby people were getting progressively richer. There was more money around today than there was yesterday. And it's interesting that the Bank of England was founded at a time when the economy was starting to show some significant signs of growth, so that it made sense to establish something as curious as the Bank of England, which was based on the loan of money, which was to be repaid at interest. That only makes sense if you believe there's going to be more money around tomorrow to repay your debt with interest than there was today. Question number 3. How much of all the money in circulation in the UK today, which is also known as broad money, was produced by the Bank of England? Was it 3%, 10%, 51%, or 100%? How much of the money in circulation in the UK today was produced by the Bank of England? Take a moment to ponder that. The answer is just 3%. This includes cash, notes and coins, and so-called central bank reserves. These reserves are electronic money created by the Bank of England, mostly as loans to the government and other commercial banks. The rest of the money in the economy, some 97%, has been lent into existence by high street and other commercial banks as interest-bearing debt. And this is known as commercial bank money. And here's a graph which illustrates how that commercial bank money has grown in volume since the early 1960s. The line that's labeled M4 there is broad money, which is the total amount of money in circulation in the economy. And as you can see, that has grown quite considerably over the intervening decades. Whereas those two lower lines in different shades of grey, which reflect notes and coins in circulation and central bank reserves, well, they've stayed pretty flat by comparison, haven't they? What that shows is that most of the money that's sloshing around in our economy these days is money that has been created out of thin air by commercial banks as interest-bearing debt. So when a debt is repaid, the interesting thing is that that money ceases to exist again. It was created from nothing and disappears into nothingness again at the end of the day. It simply vanishes. But the interest paid to the bank by the borrower doesn't disappear. That stays in the economy. And this is the profit made by the bank on the loan, of course. And it's why it made the loan in the first place. After all, banks aren't charities. So where did the money come from? Let's just recap that process again. First of all, you have a loan made to an entrepreneur, shall we say, by a bank. It appears out of the blue. And the entrepreneur goes away, does his thing, and makes more money. So the amount of money that's around after the investment has taken place is greater than the original sum loaned. And that larger amount of money is made up of 3 components. First of all, the original loan. Secondly, the interest payable on that loan to the bank. And thirdly, the profit on the business venture, which of course the entrepreneur gets to pocket. When the loan is repaid, this happens. The original loan has disappeared, but what remains in the economy is the interest payable to the bank and the profit accruing to the borrower after the interest has been paid. Before the loan, there was nothing. After the loan's been repaid, there is something. And that is the miracle which derives from the practice of commercial banks lending money by creating it. To recap some of these points, turn now, if you would, to the video at that URL, and there's a short clip there which retells the story which we've just covered in a very winning and engaging fashion. You may want to watch it a couple of times, and the transcript is available on the Magic Money Tree webpage. So let's do a little bit of simple maths just to get our minds around what's going on when a debt is incurred on the basis of an interest payment. And the distinction, incredibly important distinction, between simple interest and compound interest. Let's take some easy numbers here. Imagine an initial debt of £100. You borrow £100 from the bank and you agree to pay it back with an interest rate of 10% per annum. So very obviously, after 1 year, you'll owe £110. After 2 years, you'll owe £120 and so on. After a century, should that debt still be outstanding, then you'll owe £1,100. But compound interest is different. It's, again, the same principle of £100, the same interest rate of 10%. But after 1 year, it looks very similar, doesn't it? You owe £110. The original principal plus 10% of that principal, 110. But with compound interest, the interest payable after the second year is 10% not of the initial debt, but of the amount outstanding at the end of that first year. So 10% of 110, of course, is 11, which means that after the second year, you owe a total of £121. Already, you notice the difference when you contrast it with simple interest. By the end of the third year, you owe the original debt plus the accumulation of what's there at the end of the second year, and 10% of £121 as well. So you owe a total of £133.10 at the end of that third year. And should you be around at the end of a century, your debt will have increased to a mouth-watering £1,378,061. Quite a bit more than the 1,100 that would have been owed under simple interest. Compound interest, which is how our money system works, builds up debt very rapidly indeed. And here's a graphical representation of that. The blue line is simple interest. Imagine that's time along the horizontal axis, the x-axis. As you can see, that's just a straight line. Whereas compound interest, the red line, increases at a rate which itself increases all the time. The slope of that curve continues to increase the further up the curve you get. In fact, the slope of the curve depends on how far up the vertical axis you've gotten. The higher up the axis you get, the steeper the curve becomes. And this is known as an exponential curve. At which point it's the time to pause this video again and to turn to the short video clip at the Peak Prosperity website. Again, you might want to watch it a couple of times, and there's a transcript of the narration available at the Magic Money Tree webpage. So let's try to flesh out some of this extraordinary stuff about exponential growth and compound interest. Here's a hypothetical scenario for you in question 4. If instead of throwing them back at the chief priests and elders, which is what the Gospels tell us he did, Judas had instead invested his 30 pieces of silver in an ISA, paying the modest rate of, shall we say, 1% per annum in interest, about how much would his estate be worth today? Would it be £3 million, £3 billion, £3 trillion, or £3 zillion? Take a moment to consider that. The answer is £3 trillion, £3 million. There is, of course, no such number as a zillion. But the piece of silver that is mentioned in the Gospels, 30 of which were given to Judas in order to betray Jesus, was probably a 4 drachma coin, so they reckon. The Greek drachma was equivalent to a Roman denarius, roughly a day's pay for a manual worker in Jesus' time. Now, assuming that we can equate this to the 2018-19 minimum wage for 21 to 24-year-olds, that means that Judas betrayed Jesus for about £7,000 in today's money. Now, investing that £7,000 back in 30 AD, thanks to the miracle of compound interest, even at only 1% per annum, this would amount today to a sum in excess of the UK's annual gross domestic product. This compares with a mere 142,000, which would be produced by simple interest. And this is because with compound interest, the interest is added to the principal at the end of each year, so that at a constant rate of interest, that means that more and more is added in interest with every year that goes by. Here again is a graphical illustration of how that works. First of all, in a growing economy. If you imagine the economy as a whole, as a pie, then over the course of time, if that economy is growing, then the pie is getting bigger. So in a growing economy, I can borrow money, pay it back with interest, and make a profit without anyone else having to be worse off. If you compare the two circles in that diagram, in the bigger circle at the bottom there, obviously my share has grown because I've been clever enough to transact a successful business venture. But also I have to pay some of that back as interest to the bank. So overall, everyone else's share of the pie has got rather smaller. That's the yellow part of the diagram. But because the pie itself as a whole has grown, nobody else is any the worse off. My share and the bank's share together have grown, but because the economy as a whole has grown, nobody else need be any the worse off. However, in a stagnant economy, in other words, an economy which isn't growing, if I borrow money and pay it back with interest, even without making a profit, someone else has to be worse off. And that's what economists call a zero-sum game. In this example here, the two pies are of identical size. There's been no growth. My share hasn't grown. I haven't managed to make any profit beyond the interest which I have to pay back to the bank. But notice what's happened to the yellow part of those circles. It's got smaller. Overall, what's left to others has declined. My profit, which I've had to pay in interest to the bank, has become somebody else's loss. It's a zero-sum game if the pie as a whole is not growing. Question number 5. What did economist Kenneth Boulding say at a US Congress hearing on energy reorganization in 1973? Was it A, I think that radiator would look better in the corner, don't you? Was it B, anyone who believes exponential growth can go on forever in a finite world is either a madman or an economist? Was it C, you don't have to be mad to work here, but it helps? Or was it D, how many economists does it take to change a light bulb? Well, that depends on their marginal productivity as a function of the prevailing fiscal regime. No prizes for guessing the correct answer to this one. It's B. Now, economic growth is usually expressed as the annual change in gross domestic product, or GDP. And GDP in turn is defined as the value of goods and services produced and consumed within a given country or region in a given period. We'll be thinking some more about the limitations of GDP as a measure of well-being and of progress in the next session. Finally, question 6. When the policy of austerity was adopted in 2010 in order to reduce the government deficit, which sector of the economy was most indebted? Was it A, the government? Was it B, financial corporations? Was it C, non-financial corporations? Or was it D, households? Take a moment to reflect on that. The answer is B, financial corporations. Back in 2010, the league table for debt as a proportion of GDP looked like this. Financial corporations, 210%. Non-financial corporations, 110%. Households of 100%. Government, 75%. And here's a chart produced by PricewaterhouseCoopers. It doesn't include statistics for financial corporations, but it speaks for itself, doesn't it, in terms of the relative proportions of debt by each of these three remaining sectors of the economy since 2000. They produced this in 2017, and they projected forward, as you can see, to 2023. Little did they realize that COVID-19 was around the corner back then, of course, any more than we did. So those figures for 2023 will probably end up looking rather different. But what I wanted you to notice in particular was, quite apart from government debt, the way in which they anticipated that non-financial corporate debt and household debt was likely to rise quite significantly again going forward into the 2020s. And a couple of slides really now to bring out the human impact of debt, chronic unpayable debt. Back in 2017, a survey by the Insolvency and Restructuring trade body R3 found that some 41% of British adults are worried about their levels of debt. Half of these are worried about credit card debt. Some 40% of adults say they often or sometimes struggle to make it to payday. And almost a third of these do so because of credit card repayments. And here's Jack's story, a member of the Unfair Debt Group. His name's been anonymized. Back in 2013, my wife had an accident and was left disabled. I had to alter my house completely to meet her needs. The refurbishment cost £30,000. And to do this, I spent all my savings, plus I had to borrow on credit cards. I've used 3 credit cards from high street companies. Between them, I've borrowed £11,000. I've already paid back nearly £30,000 in total, and yet because of the high interest, I still owe the same £11,000. Interest-bearing debt can be crippling. And finally, here's a graph that merits extended study. So you may want to pause the video at this point, simply to say before you do that, that this is the story of the Bank of England's base lending rate, all the way through from 1694, when the bank was founded, till today. This is the basic lending rate at which the Bank of England lends funds to other financial institutions. Now take a moment to study this graph. I wonder what you find remarkable about it. I think there are a number of things that are striking there. First of all, the fact that the interest rate remained flat at around about 5% with a few step changes here and there for something like 100 years, from the mid-1700s through to the early 1800s. That probably reflects the fact that in the pre-modern world, the charging of interest on loans was regarded as usury, a sin, a very bad thing indeed. And even when, in the course of the 16th century, church authorities began to pragmatically allow a modest level of interest to be levelled on loans, that was maintained to what was deemed to be a minimal level. And as you can see, it was held steady at 5% for a very long time. Then in 1833, legislative changes meant that the old usury laws were scrapped, and we go into that period of 1815 to 1914, described there as the UK's economic heyday, where interest rates go all over the place. They are held flat here and there, again in the aftermath of the Great Depression and around about World War II. But notice how the interest rate begins to climb once we get into the 1950s, reaching an all-time high in the early 1980s on the back of the great inflation of the 70s and early 80s, when high interest rates were used as a tool for trying to bring inflation under control. And of course, since then, interest rates have declined quite precipitously until, on the back of the 2008 financial crash, they've collapsed to less than 1%. As I record this, it's just gone down to 0.1%. Now, the really striking thing is that never before in the history of the Bank of England has their base lending rate been this low. It's never dropped below 2%. Not in more than 300 years, despite 2 world wars, despite depressions, all kinds of financial ups and downs. It's never dropped below 2%. And yet since 2009, it's been below 1%. And let's face it, shows no signs at the moment, at least, of going upwards from there. And what does that tell us about our money system? It rather suggests, doesn't it, that we are in uncharted waters and at the beginning, quite possibly, of a wholly new phase in the way our economy works. So what have we learned in this session? Well, first of all, that commercial banks get to create money out of thin air. The Bank of England was founded partly in order to make money for private lenders, not in order for thrifty people to squirrel away their savings. Almost all the money in the economy exists because someone has gone into debt and is paying interest on it. And with compound interest, the additional amount owed increases with every passing unit of time. That's exponential growth. And in this kind of system, the whole economy has to grow exponentially if one person's gain isn't to mean another's loss. And finally, interest rates have never been this low since the Bank of England was founded. What does this tell us about our money system and where things are headed? Thank you for your company. Session 1.4 will help us to think some more about this extraordinary phenomenon of growth, which we've come to take for granted, and to reflect a bit more on other ways in which our well-being and the progress of human society can be measured.